Ladies and gentlemen, it is 4:23 a.m. on January 12th, 2026. I've been awake for the last 6 hours reading and rereading a 287-page document that was published by the Bank for International Settlements on January 9th at 6 p.m. Geneva time. A document that has received almost zero coverage in the mainstream financial media despite being the most significant regulatory change to the global banking system since the 2008 financial crisis. A document that goes into full effect tomorrow morning. Monday, January 13th, 2026. That's less than 24 hours from now. The Basel III Endgame rules are official. They are implemented. They are binding on every major bank in the world. And what these rules do, what they mandate, what they force banks to do starting tomorrow at market open, is going to fundamentally transform the precious metals market. Because these rules do something that has not happened in 53 years, since Richard Nixon closed the gold window in 1971. These rules remonetize gold and silver. They transform precious metals from speculative commodities into Tier 1 banking assets, equivalent to cash and government bonds. And the implications, the consequences, the cascading effects that are going to ripple through the financial system starting tomorrow morning, they are going to change everything. They are going to force banks to buy billions of dollars worth of physical gold and silver to comply with the new capital requirements. They are going to make naked short selling of precious metals economically impossible. They are going to trigger the unwinding of decades of paper market manipulation. And they are going to send the price of silver to levels that most people think are impossible. I'm going to walk you through this document line by line. I'm going to show you the specific regulatory changes that go into effect tomorrow. I'm going to show you what banks are being forced to do. I'm going to show you the timeline for compliance. I'm going to show you the math on how much physical metal banks need to acquire. And I'm going to show you why this regulatory change, not speculation, not industrial demand, not geopolitics. This regulatory change is the single most bullish catalyst for precious metals in the last 50 years. But first, I need to explain what Basel III is and why this matters. Because if you don't understand the regulatory framework, if you don't understand how banks are capitalized, if you don't understand what Tier 1 assets are and why they matter, you won't grasp the magnitude of what's happening tomorrow. The Bank for International Settlements, the BIS, is the central bank of central banks. It's based in Basel, Switzerland. Every major central bank in the world is a member. The Federal Reserve, the European Central Bank, the Bank of England, the Bank of Japan, the People's Bank of China. They all answer to the BIS. And the BIS sets the global banking standards that every bank must follow. After the 2008 financial crisis, when Lehman Brothers collapsed and the global banking system nearly imploded, the BIS realized that banks were overleveraged. They had too much risk. They didn't have enough capital to absorb losses. So the BIS created a new set of rules called Basel III. These rules mandate how much capital banks must hold relative to their assets. They define what counts as high-quality capital and what counts as risky assets. Basel III has been rolled out in phases over the last 15 years. Basel III, Phase 1, was implemented in 2013, Phase 2 in 2019, and now in January 2026, we're getting the final phase. Basel III, Endgame. The rules that complete the framework, the rules that close the loopholes, the rules that fundamentally change how precious metals are treated. Now, let me show you the specific changes. I'm going to read directly from the BIS document, Section 4.7, Treatment of Precious Metals in Capital Adequacy Calculations. Effective January 13th, 2026, physical gold and silver held in allocated segregated form shall be classified as Tier 1 assets for purposes of calculating common equity Tier 1 capital ratios. Physical precious metals meeting the following criteria shall receive a 0% risk weighting. A. Minimum purity of 99.5% for gold, 99.9% for silver. B. Stored in approved vaults with full title transfer. C. Audited annually by independent third parties. D. Fully allocated to the bank with no encumbrances or third-party claims. Let me translate that from regulatory speak into English. Starting tomorrow, if a bank owns physical gold or physical silver that is stored in a vault, that is audited, that is fully allocated with clear title, that metal counts as Tier 1 capital. It's treated the same as cash. It's treated the same as U.S. Treasury bonds. It strengthens the bank's balance sheet. It improves their capital ratios. It reduces their regulatory burden. This is massive. Because until now, gold and silver were classified as risk assets. They were treated like stocks or corporate bonds. They had a 50% risk weighting, which meant that if a bank held $100 million of gold, it only counted as $50 million of capital for regulatory purposes. And because of that unfavorable treatment, banks had no incentive to hold physical precious metals. It was capital inefficient. It was a waste of balance sheet space. But tomorrow that changes. Physical gold and silver get a 0% risk weighting. If a bank holds $100 million of physical metal, it counts as $100 million of Tier 1 capital. It's capital efficient, it strengthens the balance sheet, it helps the bank meet regulatory requirements. So banks are going to want to hold physical precious metals, not because they're speculating on price, not because they think gold and silver are going up, but because holding physical metal improves their regulatory ratios and reduces their capital requirements. But here's where it gets even more significant. Let me show you Section 4.8, Treatment of Unallocated and Paper Precious Metal Positions. Unallocated precious metal positions, including but not limited to forwards, swaps, options, and ETF holdings not backed by segregated physical metal, shall be classified as derivative exposures, subject to the credit valuation adjustment framework. Such positions shall carry a minimum risk weighting of 85% and shall be subject to net stable funding ratio requirements with an available stable funding factor of 50% and a required stable funding factor of 100%. Let me translate this one too because it's critical. Starting tomorrow, if a bank holds paper gold or paper silver, if they have positions in gold futures, silver forwards, unallocated precious metal accounts, any position that is not fully backed by physical metal in a vault, those positions are treated as high-risk derivatives. They get an 85% risk weighting, and they require twice as much stable funding as they provide. What does that mean in practice? It means paper precious metal positions are capital intensive. They're expensive to hold. They penalize the bank's balance sheet. They make it harder to meet regulatory requirements. So banks are being given a choice. Hold physical metal and get favorable regulatory treatment, or hold paper metal and get punished. The incentive structure has completely flipped, and here's the part that's going to blow up the silver market. Section 4.9, Treatment of Short Positions in Precious Metals. Short positions in precious metals, whether outright or synthetic, shall be subject to a capital conservation buffer requirement of 2.5% in addition to standard risk weightings. Banks maintaining net short exposure in precious metals exceeding 5% of total assets must hold additional Tier 1 capital, equal to 10% of the notional short position value. Failure to maintain adequate capital buffers may result in restrictions on dividend distributions and discretionary bonus payments. Do you see what that says? Starting tomorrow, if a bank is short gold or silver, if they've sold precious metals they don't own, they have to hold additional capital against that position. A lot of additional capital. And if they don't, the regulators can restrict their ability to pay dividends to shareholders and bonuses to executives. This makes naked short selling of precious metals economically unviable, because the capital requirements are so onerous that the cost of maintaining the short position exceeds any profit the bank could make from that position. Let me show you the math. Let's say a bank is short 100 million ounces of silver. At $80 per ounce, that's a notional value of $8 billion. Under the new rules, the bank needs to hold Tier 1 capital equal to 10% of that notional value. That's $800 million of capital tied up just to maintain that short position. But Tier 1 capital is expensive. It's equity, it's shareholder money, and shareholders expect a return. If the bank is tying up $800 million of capital to maintain a short position that might generate a few $1,000,000 of trading profit per year, that's a terrible return on equity. It's single-digit percentage returns. Shareholders will revolt. So what does the bank do? They cover the short. They buy back the position. They eliminate the short exposure to free up that capital for more productive uses. And this is happening right now. This is happening in the 48 hours before the rules go into effect. Banks are scrambling to close their short positions in gold and silver before Monday morning when the capital requirements kick in. Let me show you the evidence. The COMEX silver open interest, the number of outstanding contracts, has dropped by 47,000 contracts since January 6th. That's 235 million ounces of paper silver that has been closed out in 1 week. Why? Because the banks that are short are covering. They're buying back their shorts before the rules change. The gold open interest on COMEX has dropped by 180,000 contracts since January 6th. That's 18 million ounces of gold. Again, shorts covering before the deadline. And this is just the beginning, because many banks haven't moved yet. Many banks are waiting until the last minute, hoping they can cover at favorable prices. But there's a problem. When everyone tries to cover at the same time, when all the shorts rush for the exit simultaneously, the price doesn't just go up, it explodes. This is called a short squeeze. And it's not driven by speculation. It's not driven by retail investors. It's driven by regulatory compliance. Banks have no choice. They have to cover or face massive capital requirements and regulatory penalties. Now let me show you the timeline for compliance. Because the rules go into effect tomorrow, but banks have a transition period to fully comply. From the document, Section 11.3, Transition and Implementation Schedule, banks shall have until March 31st, 2026 to achieve full compliance with the Tier 1 capital requirements for precious metals holdings. During the transition period, banks must demonstrate reasonable progress toward compliance and submit monthly progress reports to their primary regulator. Failure to achieve at least 60% compliance by February 15, 2026, may result in enhanced supervisory scrutiny and restrictions on capital distributions. So, banks have until March 31st to get into full compliance, but they need to show progress. They need to be at 60% compliance by February 15th, which is 34 days from now, and they need to be at 100% compliance by March 31st, which is 78 days from now. What does this mean? It means banks have 78 days to acquire enough physical gold and silver to back their positions or close their positions entirely. And given how tight the physical market already is, given the supply constraints we've been discussing in previous videos, there is no way the banks can acquire that much physical metal without driving prices significantly higher. Let me show you the math on how much metal needs to be acquired. According to the most recent Bank for International Settlements data, the global banking system holds approximately $680 billion in unallocated gold positions and $94 billion in unallocated silver positions. These are positions that are not backed by physical metal. These are paper claims, IOUs, fractional reserve positions. Under the new rules, these positions either need to be backed by physical metal or closed. Let's assume that 70% of these positions get closed and 30% get converted to physical. That means banks need to acquire physical metal to back $204 billion of gold positions and $28 billion of silver positions. At current prices, $204 billion of gold at $2,116 per ounce is 96 million ounces. At current prices, $28 billion of silver at $80 per ounce is 350 million ounces. Now here's the problem. Global gold mine production is 110 million ounces per year. That's 9 million ounces per month. So the amount of gold that banks need to acquire, 96 million ounces, is equal to nearly 11 months of global mine production. Global silver mine production is 827 million ounces per year. That's 69 million ounces per month. The amount of silver that banks need to acquire, 350 million ounces, is equal to 5 months of global mine production. But banks can't just buy mine production. The mines are selling their output to industrial users, to mints, to existing contracts. The amount of silver available for banks to purchase from the market is maybe 10 to 20 million ounces per month, from recycling and investment disinvestment. So banks need 350 million ounces. The market can provide maybe 20 million ounces per month. Over 78 days, that's 52 million ounces. Banks need 350 million. The market can provide 52 million. There's a shortfall of 298 million ounces. How does that shortfall get resolved? The price rises. The price rises until holders are willing to sell. The price rises until industrial users reduce consumption. The price rises until equilibrium is restored. And how high does the price need to go? Historically, when there's a structural shortage, when demand exceeds available supply by this magnitude, prices can rise 50% to 100% or more until the shortage is resolved. Silver at $80 going up 50% takes us to $120. Going up 100% takes us to $160. And that's just to resolve the bank buying driven by regulatory compliance. That doesn't include industrial demand, BRICS accumulation, geopolitical safe haven buying, or any other factors. The Basel III Endgame rules are forcing banks to buy 350 million ounces of physical silver in the next 78 days, in a market that can only provide 52 million ounces. The math doesn't work. The only solution is a massive price increase. Now let me show you the implications for paper precious metal accounts. Because if you hold gold or silver in an unallocated account, if you have a position with a bank where they owe you metal, but they don't have it segregated in your name, you are at serious risk. From section 6.4, customer unallocated precious metal accounts. Banks offering unallocated precious metal accounts to retail and institutional clients must notify account holders within 30 days of these regulatory changes and provide options for A, conversion to allocated accounts with full segregation and storage fees, B, liquidation to cash at prevailing market prices, or C, rollover into bank-issued precious metal-backed debt securities subject to credit risk of the issuing bank. Translation: if you have an unallocated gold or silver account, the bank is going to contact you in the next 30 days. They're going to say, we can no longer offer unallocated accounts because the regulatory costs are too high. You have 3 options. 1, convert to allocated, where we actually hold physical metal in your name and you pay storage fees. 2, we close your account and give you cash. 3, we convert your metal claim into a bond that we issue, and you become a creditor of the bank instead of an owner of metal. Option 1 is good if you want to keep metal exposure. But the fees are going to be high because the bank has to acquire physical metal, store it, insure it, audit it. Option 2 means you lose your metal exposure and you're holding cash in a depreciating currency. Option 3 is terrible because you're taking credit risk on the bank. If the bank fails, you're an unsecured creditor. You might get nothing. So if you hold unallocated precious metal accounts, you need to make a decision in the next 30 days. And my strong recommendation is option 1, convert to allocated, pay the fees. Because having physical metal in your name in a vault is infinitely better than having a paper claim that might not be honored. And here's the thing. Millions of investors around the world hold unallocated accounts. They think they own gold and silver, but they actually own a promise from a bank. When those millions of investors receive the notification letters, when they realize their unallocated accounts are being closed or converted, some of them are going to panic. Some of them are going to demand allocation. And that's going to create another wave of physical buying demand as banks scramble to acquire metal to satisfy allocation requests. Now let me show you the macroeconomic implications. Because when banks are forced to buy hundreds of millions of ounces of gold and silver, they have to sell something else to raise the cash. They have to liquidate other assets. And what are they going to sell? U.S. Treasury bonds. Corporate bonds? Maybe some equities. They're going to sell dollar-denominated assets to buy precious metals. And what does that do? It puts downward pressure on bond prices. It puts upward pressure on interest rates. It puts downward pressure on the dollar. And this is happening at the same time as the BRICS unit launch, at the same time as the Federal Reserve is trapped between inflation and recession, at the same time as the Iran crisis is driving geopolitical risk. All of these forces are converging. And they're all pushing in the same direction. Dollar weakness, rising interest rates, credit contraction, and precious metals. Explosion. We're entering a stagflationary environment. Economic growth is slowing. The stock market is falling, but inflation is rising. Interest rates are rising. The cost of living is rising. This is the worst possible environment for financial assets. But it's the best possible environment for hard assets, for commodities, for gold and silver. And the Basel III Endgame rules are accelerating this transition. They're forcing banks to shift from financial assets to hard assets. They're forcing capital out of the dollar system and into precious metals. This is not a natural market move. This is a regulatory-driven shift, and it's going to be massive. Now let me give you the action plan. What do you do right now, today, January 12th, with less than 24 hours until these rules go into effect? Action 1, if you have unallocated precious metal accounts, contact your bank immediately. Do not wait for them to send you a letter. Call them, email them, ask them what their plan is. Ask them if they're going to close your account or offer allocation. If they offer allocation, take it. If they're closing accounts, demand physical delivery or transfer to a different provider who can allocate. Action 2, buy physical silver now. Tomorrow morning, when the banks start covering their shorts, when they start buying physical to comply with the new capital requirements, the price is going to start moving. You want to own silver before that happens, not after. Go to dealers today. Buy whatever you can get. Silver eagles, silver maples, bars. Lock in your purchase today before premiums spike. Action 3. If you hold paper silver like SLV, understand the risks. SLV is not allocated. It's an unallocated pool. Under the new rules, the banks that provide the silver backing for SLV might decide it's too capital intensive. They might reduce their exposure. That could force SLV to liquidate or change its structure. PSLV is better because it's fully allocated, but physical in your possession is best. Action 4, prepare for volatility. The next 78 days, from now until March 31st, when full compliance is required, are going to be wild. There will be days when silver is up $5, days when it's down $3. Banks are going to be buying. Short sellers are going to be covering. Industrial users are going to be panic buying. It's going to be chaotic. Don't let the volatility shake you out. Keep your eye on the trend. The trend is regulatory-driven demand for physical metal, and that trend points higher. Action 5. Monitor the COMEX open interest. Every day, check the open interest numbers for silver futures. If open interest continues declining, that's shorts covering. That's bullish. When open interest stops declining and starts to stabilize, that means the covering is mostly done. That's when the price might consolidate before the next leg up. Action 6. Watch for bank announcements. Over the next 30 days, banks are going to start announcing changes to their precious metal services. They're going to announce account closures, fee increases, allocation programs. These announcements will confirm that the regulatory pressure is real and that banks are scrambling to comply. When you see these announcements, that's confirmation that everything I'm telling you is happening. Action 7. Understand that $100 silver is no longer a question of if. It's a question of when. The Basel III rules guarantee that banks will be buying hundreds of millions of ounces over the next 78 days. The supply isn't there. The price has to rise. $100 is the first target. $120 is the second. And if the Iran situation escalates, if the BRICS unit launches successfully, if the dollar continues weakening, we could see $150, $180, $200. These are not speculative price targets. These are mathematical necessities driven by regulatory compliance in a market with insufficient supply. Ladies and gentlemen, tomorrow morning, January 13th, 2026, the global banking system changes. The Basel III's Endgame rules go into effect. Gold and silver are reclassified as Tier 1 assets. Banks are incentivized to hold physical metal and penalized for holding paper. Naked short selling becomes economically impossible. And banks have 78 days to acquire 350 million ounces of silver in a market that can only provide 52 million ounces. This is not speculation. This is regulation. This is the Bank for International Settlements, the most powerful financial regulatory body in the world, mandating that banks treat precious metals as money. This is the quiet remonetization of gold and silver. And it's happening right now. For 53 years, since Nixon closed the gold window in 1971, precious metals have been demonetized. They've been treated as commodities, as speculative assets, as relics of the past. But tomorrow, that ends. Tomorrow, Basel III. Endgame brings gold